Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, August 13th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Now, this chart here, the first chart that we're going to look at, is a weekly candlestick chart of the S&P 500. That starts at the beginning of 2021, and the green line is the 40-week moving average. The S&P 500 was up 0.71%, so 71 basis points this week, and you can see here clearly that we closed at another new all-time weekly closing high on the S&P 500 this week. We closed at 4468.00, and where we closed this week, we are now trading 11.13% above the 40-week moving average. So if we were to pull back to the 40-week moving average anytime soon, that would be a correction. As you may know, a correction is when something falls 10% from its previous high. So if we were to pull back to the 40-week moving average anytime soon, that would result in a correction. And this week we had a little bit lower volume, but I looked at a lot of charts when I was trying to choose which charts to put in this video, and across the board the volume was down this week. That's not really uncommon during the summer months, and that was true whether it was up volume or down volume. So and that is something I do pay close attention to, and I would encourage you to do the same thing. But so up this week on lower volume, but there was several things that were down this week also on lower volume. So the fact that volume had dropped a little bit this week, I wouldn't read too much into that. Just I think summer months, right? Just a little bit slower time for the markets. Not as many market participants or trades being placed. So nothing too concerning right there on the lower volume, even though the market was up. The next chart that we're going to take a look at is for the IWM. This is an ETF that tracks the Russell 2000 Small Cap Index here in the U.S. This is also a weekly candlestick chart, so each candlestick does represent 1 week of trading, and the green line is still the 40-week moving average. Now, this was the weakest area of the U.S. stock market this week, was the small caps, and we can see that the IWM was down a little over 1%, 1.01% for the week. And the other thing that's been interesting here about small caps, and this really has been one of the weakest areas in the U.S. stock market for 2021, after being one of the strongest areas for a good portion of 2020, of course, coming out of the COVID downturn in March of 2020. So small caps really helped lead the way, but they kind of peaked in February here, and you can see this real tight sideways trading that we've seen in the small cap area since the first part of February. Now, I'm not too concerned about that. You can see that that's not atypical. If we go back to 2019, you can see a real tight sideways trading range for many, many months in 2019, and then it finally broke out, only to encounter the resistance that we saw, obviously, and then the downturn from COVID-19 right here. So, small caps were starting to break out before the COVID-19 downturn, and then, small caps, again, let us out of the way. But we've had this sideways trading action, and we even pulled back to the 40-week moving average right here in July. So, again, this has been one of the weaker areas, but a lot of times these sideways bases can be very, very constructive and allow the market to go higher from here rather than actually rolling over and falling much. So it's just kind of a sideways grind here. There's no way to know ahead of time whether the market will roll over or if we're going to be able to break out like we started to right here in the latter part of 2019, of course, before COVID-19. But the sideways bases, right, that we're seeing being built right here on IWM, again, can be very, very constructive. And as I was pointing out on the previous chart of the S&P 500, volume across the board seemed to be down this week, whether it was up volume or down volume. So the fact that the IWM was down a little bit this week on lower volume, again, the 1% down, not a big deal. And again, we're staying above the 40-week moving average. So as long as the IWM continues to trade sideways and hopefully stay above the 40-week moving average, we really should view this as a constructive move in the IWM after a very, very big move during the latter part of 2020 and the first month of 2021. The next chart that we're going to look at is for the FXI. The FXI is an ETF that tracks the China large caps. And guys, this has been by far one of the weakest areas that I've seen across the globe. The FXI had a very nice run, just like small caps and a lot of other things coming out of the March downturn in 2020 because of COVID. And you can see we stayed above this uptrend line for about 1 year. However, we can see that the FXI peaked in February of this year and has fallen considerably since. And we are trading well below the 40-week moving average on the FXI. And then I'm going to go ahead and pull up my annotation tool here. And let's just drop a line on here because I want you guys to see this. So obviously we can see right here. I'm just going to leave that line just barely above. You can see right here where the candle is where we finished up for the week. And the reason I did this, and I wanted you guys to see me drop that line, if we, here again is this week's candle. If we go all the way to the left, again, this chart starts in 2018, we can see that we are trading below where we started in 2018. So, long-term investors, and I'm going to show you another chart here in just a second, so stay with me because this is interesting. And guys, it's not just about the FXI. What I'm trying to help you understand is how to think about these things, whether you're looking at individual stocks, ETFs, mutual funds, whatever, right? It's the process of analysis, using technical analysis. And when you see something like this that's trading below where it has traded for years, it's not good, right? And again, I am not picking on the FXI. I'm only using this really as an example to illustrate a few points that I hope are getting through. One of which is, the thought of diversification. People say, well, you have to be diversified or you have to be invested internationally. Well, I think we need to think a little bit further about that because diversification like this by itself, it's hurting you, right? It's not helping you, right? You'd be much better off being in just the S&P 500 rather than having the S&P 500 and some FXI in your portfolio. Again, I'm not picking on the FXI. I'm trying to make a point here. Now, let's move on to a longer-term chart of the FXI to really illustrate the point here, guys. This is a monthly chart of the FXI that goes clear back to the inception of this ETF back in 2004. I took the chart clear back to 2002 just so you could really see right where the IPO was for this ETF, and you can see that the ETF FXI really ramped up right into 2007 and hit 53.01 right here. Now that for the longest time, actually until the first couple of months of this year, till February of this year, that 53.01 was the all-time high in the FXI. So think about that. Again, long-term buy and hold investors, right, in this ETF didn't make any money for about 14 years. We finally breached the 53.01 level, got to 54.35, as you can see right here in February of this year. And, well, we know what has happened since February, right? It's fallen, it's fallen, it's fallen. So now, right, we closed on Friday the 13th here at 41.35. And if, again, we go to the left, and let me just grab this annotation tool really quickly. So, again, just to get a ballpark here. And you can, again, see that, here's where we ended up this week, right? We're about halfway through the month of August. And people that got in, if anybody got in here, they're still underwater. But even people that have held this thing, for 14 plus years, haven't made any money. Okay. So it's not just about the FXI, guys. I'm trying to teach you how to think about these investments. And you may want to think about, anything in your portfolio, whether it's an individual stock, a mutual fund, an ETF, whatever. If it's not working, it's not working. Okay. So, just think about that. Maybe find a few things in your portfolio, right? And call them weeds, right? This would be a weed in my opinion, right? If you're looking at it like a garden, and every once in a while you have to weed the garden, right? You have to pull out those things that aren't working, and and move on to those things that are working. Okay, like the S&P 500. Now, again, the IWM, just some sideways trading here. I wouldn't worry too much about that just yet. It more than likely is just a nice sideways base here. But when you get into something like this, right, that's been basically going sideways for 14 or so years, regardless of what it is, that isn't necessarily a good thing. Now, in the future, it might turn out to be another really good investment, right? But it needs to turn around. It needs to start acting properly. It needs to break out to the upside before, in my opinion, it becomes a worthwhile investment. So hopefully this gave you some food for thought and this made some sense. Let me ask you a few questions. Do you manage any of your own money, including in your 401k or your IRA? Have you ever found yourself out of sync with the market, underexposed when the market is rising, or overexposed when the market is declining? If you answered yes to any of these questions, please pay close attention to the balance of this video, because it could be worth a lot of money to you going forward. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors, and what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors, and what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then of course the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios, and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition. So whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.